Look, there are over 80,000 pages in the tax code, and on one of those pages, it allows you to deduct almost anything. Just take a look for yourself. Section 162 of the Internal Revenue Code says that you can deduct all ordinary and necessary expenses paid or incurred during the taxable year to carry on any trade or business. Folks, get ready because in today's episode, I am going to explain how you can write off almost anything. Hey everyone, it's Sherman, a CPA here at Life Accounting, where we help you save on taxes and increase your wealth. And if that interests you, be sure to subscribe to our channel so you don't miss out on all of the ways you can save and make more money. Today, I am going to teach you how to write off almost anything. And what I'm about to tell you is not some type of tax loophole that can get you in trouble. In fact, it's quite the opposite. Tax write-offs and deductions are available for everyone. It's quite literally written as part of the tax code to incentivize people to take the actions necessary to grow the overall economy. The problem is that most people are completely intimidated by taking these tax deductions and write-offs, so much so that they don't end up taking them at all and wind up paying way more in taxes than they actually have to. In fact, some experts say that the average person will spend 25 to 35% of their entire life working to pay off their taxes. Just think about that. 25 to 35% of your life not being spent to pay off your rent or mortgage, not to invest into the stock market or real estate, or even your business. But no, literally just to pay taxes to the government. Even crazier, a lot of people think that the tax code is their enemy. But the tax code is not your enemy. It was not written to just take your money. It was written to grow the economy, boost jobs, provide affordable housing, and promote many initiatives that the government relies on to provide for its citizens. Therefore, if you can make the tax code your friend, then you will be able to benefit from how it was written in the first place. I mean, just think about it this way. If there were no businesses, there would be no jobs. That would be a disaster, right? So the government allows business owners to take write-offs that are not available to employees. Or how about real estate? If there is no affordable housing, people would not have anywhere to live. Now that obviously would be chaotic, right? So the government encourages real estate investment by allowing investors to write off things like depreciation, which literally costs them no money directly out of their pockets, and many more write-offs and deductions to incentivize more investment into real estate. So what is my point here? My point is that you can lower your tax bill, not by cheating the system, but by instead aligning yourself with the incentives that lie within the system. If you stick around until the end of this episode, then I promise you that you are going to know much more about how taxes work, and more importantly, how you can take advantage of tax write-offs to lower your taxable income. By the way, if you enjoy topics like this, then please help me out by clicking the like button below and commenting. With that said, let's break this all the way down. All right, so what are tax write-offs and tax deductions? First of all, tax write-offs and tax deductions refer to the exact same thing. So anytime you hear someone say tax write-off, just know that they are technically referring to tax deductions. Now, ultimately, tax deductions are eligible expenses that you can deduct from your taxable income. With that said, there are two different types of taxpayers. Average taxpayers, which would be wage earners, and then there are super taxpayers, which is what I would call them, who are primarily business owners and investors. Now, in a moment, you will see that super taxpayers reap the most tax benefits because they align themselves more closely with the interest of the federal government. With that said, let's start by looking at the average taxpayer first, and then we'll move on. So the average taxpayer, again, is someone who may have a job, a family, and a mortgage or rent. Now, the tax code was written to provide for the average taxpayer rather than incentivize them to take certain actions. The government wants to make sure that this person has access to jobs, affordable housing, health care, and so on. Therefore, the tax code does not incentivize the average taxpayer as much. Average taxpayers, like wage earners, are very limited in what they can actually deduct from their taxable income. But they can take advantage of standard deductions or itemized deductions. Now, the standard deduction is available to all taxpayers. For example, in 2021, single taxpayers can deduct $12,500 from their taxable income, and married taxpayers can deduct about $25,000 roughly. So if you are married and have $100,000 in income, then you can immediately deduct $25,000 from your taxable income and only pay taxes on the remaining $75,000 in income. Or you can choose to itemize your deductions if you have certain expenses that exceed the standard deduction. Now, itemized deductions allow you to deduct things like your home mortgage interest, your property taxes, any charitable contributions that you made, and other specific items. The idea here is that if your itemized deductions exceed what you can take as a standard deduction, then you should itemize to lower your tax bill to the best of your ability. For example, if you are single and have $15,000 in itemized deductions, then you should likely itemize since the standard deduction is only about $12,500. Other than taking the standard deduction or the itemized deduction, there is very little that the average taxpayer can do to lower their income taxes outside of contributing to some type of retirement account to defer taxes until a later date. Therefore, if you are an average taxpayer and you want to take advantage of the tax code to write off almost anything, you are going to have to find a way to contribute to the overall economy through things like business or real estate. And if that's you, what you want to become is a super taxpayer. Basically, you want to go from an average taxpayer to a super taxpayer. So let's take a look at what we mean by super taxpayer. Super taxpayers are business owners and investors. These taxpayers can deduct almost anything from their income given the right set of circumstances. The tax code that I showed you earlier specifically referred to business owners. As long as the expense is a business or investment expense, then they can generally deduct it. And if that business expense provides a personal benefit, then that is just a plus of being a super taxpayer. So what exactly is a business expense that you can deduct? Well, in general, if the purpose of the expense is to produce more income, then it can likely be deducted. That's why super taxpayers can deduct business meals as long as they are eating and discussing business. They can deduct that meal from their income. Super taxpayers can deduct their business vehicles as long as the vehicle is being used for business or is being used to advertise that business, then they can deduct it. Super taxpayers can even deduct some of their home mortgage, home utilities, and property taxes as long as they are using a portion of their home to conduct business, like having a home office or a basement that you're using to store inventory or something. Super taxpayers can even deduct their vacations as long as they do some type of business during that vacation period. For example, a real estate investor might be able to deduct a vacation if they were looking at real estate in the area they were traveling in. So as you can see, super taxpayers can deduct almost anything: food, vehicles, housing costs, travel, and much more, as long as it is being used to help them produce more income in their business. But even still, many super taxpayers are still afraid of taking these deductions. Like just in the last week, some of our subscribers asked us these questions. Number one, can I write off my merchant expenses from Stripe? Can I write off eBay fees that I pay when I sell my products? Number three, can I write off company t-shirts that I use to advertise my business? Yes, yes, yes. As long as these are legitimate business expenses, you can write it off. You don't need to be afraid of taking tax deductions. It's literally written in the tax law. The problem only arises when you start claiming completely personal expenses as business deductions that have absolutely nothing to do with your business. Like, you can't just buy a Porsche and write it off from your business taxes without it serving some type of business purpose that helps you produce more income. If you are wine and dining clients, using it to travel from one business to another business, or even using it to advertise your business, then in that case, you might be able to deduct that expense from your business income. Business owners are able to write off almost anything as long as it meets a few basic requirements. Now, according to the tax code, the expense must be ordinary and necessary for carrying on your business. Now, the tax law itself does not specifically define what ordinary and necessary means. Therefore, it is up to you to determine what expenses qualify as ordinary and necessary for your business. Now, to be fair, the IRS does attempt to define this in a publication. And according to that publication, an ordinary expense is an expense that is common and accepted in your business or trade, while a necessary expense is an expense that is helpful or appropriate for your trade or your business. For example, an ordinary and necessary expense for a car dealership might be buying car parts, while for our accounting firm, it might be buying technology and software. Surely I could not deduct car tools that we're using for an accounting business. I mean, maybe I could if those car tools were being applied to a business vehicle that I was using for our accounting firm, then sure. But the idea is that you can't just start buying anything and writing it off. That's when you can start getting into some serious trouble with the IRS. So anyway, now that you understand this concept, let's talk about the steps you need to take in order to write off almost anything. All right, so step number one, you need to start a business or become an active investor. Remember, tax deductions benefit business owners and investors the most. A lot of people think that this means that they have to be wealthy to take advantage of the tax law, though. And the truth is that you don't have to be wealthy or rich or anything like that. These tax deductions are literally available for all business owners and investors, regardless of how much money you make. In fact, there are even specific deductions that were created for new business owners, like the startup and organization cost deduction that allows you to deduct your startup expenses. And literally anyone can start a business. We did an entirely separate video on our channel on how to start a business with no money. In fact, we even started our very first business with as little as $200. So of course, you can start your own business and take advantage of the tax law to your benefit. All right, so step number two is to make sure your expenses have a business purpose. If you want to deduct almost everything, you need to make sure almost everything you buy has a business purpose. For this, I want you to think about the worst case scenario here. Let's say the IRS audits you and wants to learn more about the deductions that you are claiming on your tax return. In that event, you want to be able to confidently explain to the IRS how the expenses you claimed as deductions were used to benefit your business. And as long as those expenses are in accordance with the tax law, then you should not have anything to worry about at all. All right, step number three, make sure you document everything. The third step here is to make sure that you keep up with all of your documentation, like your receipts or invoices following your purchases. Again, in the event of an audit, you don't want to be all over the place. If the IRS asks you for more information on your deductions, all you need to do is show proof of the expense and what the expense was for. That's pretty much it. But if you do not keep up with the receipts and invoices following those purchases, then you might have a difficult time proving that the expenses you claimed as deductions were legitimate business deductions. So go ahead and make your life easy by just keeping track of your receipts and invoices for your business expenses. All right, step number 4, claim the deductions on your tax return. When you file your taxes, whether you're doing it yourself or hiring a tax preparer to do it for you, make sure that you claim your deductions correctly. Specifically, make sure you are categorizing your expenses into the right places on your tax return. Now, when you file your taxes, there are specific categories for each type of business deduction, so you will want to make sure you insert the right amounts in the right categories. You should be doing your bookkeeping throughout the year, which should make all of this very easy to tally up when it's time to file your tax return. But more importantly, you need to make sure you do this correctly because any errors could trigger an audit by the IRS. All right, so there you have it, folks. This is how you can write off almost anything from your taxable income. Let me know what you're thinking in the comments below. And if you enjoyed this episode, then be sure to subscribe to our channel so you don't miss out on more ways that you can save and make more money in your business and in your personal life. I'll see you in the next episode.